The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.
Hey everyone, welcome back to another episode of In the Market Trenches. If this is your first time checking us out, we're available anywhere podcasts are available. You can check us out at snn.network. You can check us out at inthemarkettrenches.podbean.com. You can check us out at the SNN YouTube channel. That's youtube.com/SNNwire. Gary, good to see you.
Good to see you, sir.
Yeah. So what's the topic for today? No guest. It's just you and me. We're after the Thanksgiving holiday. What are we talking about?
I think today we're going to spend some time on rights offerings. What do you think about that?
I like it. We've been following a company for a little while. It's doing a rights offering now, so I like it.
We'll kick the tires on that one a little bit. I don't know that we'll do anything with it. What do you think?
With the company that we're following?
Yeah. Maybe?
I don't know. I like the leadership. Space is okay. Quality of assets is meh. But it's a rights offering, and so I want to pay attention.
Yeah, and this is sort of in the vein. The last episode we had Marco Vanderwall, Googie, and he's sort of the whole concept of rights offerings. I have to give him a tip of the hat, a tip of the beanie.
Tip of the beanie.
Snowing outside here today. It's beanie day here on In the Market Trenches, but I got to give him a tip of the beanie because. I don't think I knew him at the time, but he wrote up a rights offering on the Value Investors Club that sort of got us started on doing them and getting to know them a little bit. And, he's Googie on there, obviously, but, he wrote one of them up and this was probably, when did they write up that, the original one that we did? Was that 2013, 2014?
Probably, yeah.
I think it's 2013 because that one came with some warrants and those expired in 10 years, which was 2023, right? So it must have been a 2013 offering, September of 2013, now I recall. Okay, that helps me back into it. So rights offerings. This company that we're looking at comes out and says that they're doing a rights offering, and that just sort of got me thinking about rights offerings in general, and Googie a little bit and whatever else, and sort of, there's good rights offerings, there's rights offerings that we like, and there's rights offerings that we don't want to go anywhere near.
What is a rights offering?
Okay, so we'll start at a high level. Company, publicly traded company, wants or needs to raise some money. And you've got a variety of different ways to access capital markets. So you can do a secondary offering and just sell stock to somebody different, or you can do what's known as a rights offering, or you can do some other security, some other hybrid, you do placement, whatever. There's all kinds of different ways. But one of the more democratic ways to raise money, because lots of people, when you do a placement, they don't want, the shareholders don't like the dilution that comes from a placement. They want to be able to preserve their sort of proportionate ownership interest. One of the more democratic ways to do and allow for that is via a rights offering. So everybody who already owns stock in the company as of a given date, a record date, would have the right to put more money into the company at a specified price. So for every share you own, you'd get some right to put money in for either a whole share, a fraction of a share, several shares, sort of all over the map in terms of what we've seen and how we've seen them. But it's a right. It's a right.
And
rights.
Yeah,
offering.
and so it is a right. And if you're a holder on the record date, you will get a new symbol in your account, QSIP or a symbol, and that represents the right. And sometimes those rights are tradable, sometimes they're non-tradable. You have to look at the filing documents to see if they are going to be tradable or not.
Right.
And then that right allows you to purchase a certain amount of shares of stock. Again, you have to look at the filing documents to see what you're entitled to. And then when you we
should say stock or some other basket of securities, because we've seen instances where it's a preferred security, convertible preferred security, warrants. Maybe we've seen a debt piece here or there, but it's sort of all over the map in terms of what these things look like. It's when you've seen one, you've sort of seen one, and it's kind of and all of these sort of have their own structure to them, I'll say.
Yep.
And so this is a place that we've spent some time on over the years. It's generally a place where we've tended to do okay. But it's also one of those places where you sort of need to pick and choose your spots, right?
Right.
And so how do we go about doing that? So we have one that we're looking at right now, sort of in a beaten up sector. So oftentimes when a company's doing this, it's because the sectors, sometimes they're serial capital raisers, and those we tend to avoid. So oftentimes there's companies that do these again and again and again because they're always raising money because they're always burning through cash. That's not something that we're typically all that interested in. What we are interested in is if there's some sort of opportunity or some sort of quasi distress, and this is potentially a way of addressing it, right? Or there's some sort of investment opportunity that the money is needed for, and that's sort of when we take a look at these things. So what do we normally like to see when we take a look at one of these things?
Yeah, so I think one of the things that's interesting about rights offerings is you have a company that's looking to raise X millions of dollars of capital, and they do it via a rights offering. Well, typically what's going to happen is you're going to have a backstop party. So it's basically current shareholders as of that record date are allowed to participate. Sometimes you're allowed to oversubscribe. So there's what you're entitled to exercise, and then sometimes you get an oversubscription privilege. And this is for the regular shareholders. For any of the shares that go on an exercise, this is where this backstop party comes in. So we talked about this in the Full House episode. Full House did a rights offering, several years back, and they had a backstop party to that. And so the backstop party basically agrees to put in any of the unexercised capital so the company could fulfill what their capital raising need or desires. So
a lot of times they'll get a fee for doing so, and they'll be guaranteed a certain amount of the offering if everybody subscribes.
Right. And so we talked about this with Stephen Keel. We talked about this with Peter Rabibor in our episodes. We could talk about this with almost all of our guests, that we have to try and figure out what are the incentives of the investors. And so oftentimes, especially with microcaps, you have this backstop party that wants to put in more capital, but they can't do it in the open market. If they try and buy that amount of stock in the open market, they're just going to blow out the stock price. And so they do it via this rights offering. And
so
a lot
of times when we see this happening, it's typically smaller or microcap companies. It's not the biggest companies in the world that are raising money this way, normally, under normal circumstances. So usually it's something that's small, it's beaten up, it might have a history of disappointing investors for one reason or another, or there's some sort of balance sheet issue or something else, some other reason that they're doing it, right? And so what we're looking at is if there's a backstop agreement. Sometimes they don't have a backstop agreement. There's no backstop agreement. Well, we're typically a little bit less interested. But if there's a backstop agreement, we're taking a look at who the backstopping party is, right? Is it, so in the Full House example, it was actually the CEO himself was part of the backstopping party. That's sort of, that got us pretty interested. In others, it's maybe a big fund or something like that, right? What else have we seen in terms of some of these? In terms of the pricing, a lot of times it happens to at some sort of discount, right?
Yep.
Whether it's a discount to the last 20 trading days or some other goalpost, you see some sort of discount. And I don't know about you, but I kind of prefer when we look at these for them to be relatively large in relation to the companies. If we're interested in it, we prefer that it be somewhat large relative to the company's size, right?
Yep.
And why is that?
So for me, the size is important, but the parties that are backstopping it to me are what's more important. And so if it's large with a current shareholder that wants to put in a significantly more amount of money, to me that just says there's something good that's going to happen, or something good is evolving with the company. And I get really encouraged by that. That gets me excited.
We want it to look like as a way for people who are already involved in the company to engineer sort of an off-market deal to put money in. It's sort of a contrived price. But the reason I mentioned the size is because you mentioned sort of exercising and oversubscription privileges and all this other stuff. A lot of times you have people who are involved in these things that aren't a big shareholder or management themselves are sort of, mom and pop investors. And oftentimes they'll get these rights, whether they're tradable or not tradable. Sometimes that plays into how we think about these things. But that's almost a side issue because it's relatively large. What happens is inevitably you see sort of it sort of grinds the offering price towards the close of the offering. And so it's this mechanical aspect because you can't subscribe to these things. Like you can't use a margin. I don't think the brokers let you use margin to subscribe to your offering. And so oftentimes what will happen is people will subscribe, and let's say, the stock is $2, the offering price is $1.50. They'll at $2, they'll exercise their right, and then they'll sell the stock to financing it. And so you sort of have this mechanical aspect on what's going on in the market as this offering draws to the close. You have sort of like a whole mechanical apparatus that takes hold. And when it's big in relation to the underlying, the stronger that dynamic is, right?
Yeah, and so just to go through that example again, if you own the stock at $2 and the exercise price of the rights it's $1.50, well, you could sell your stock at $2. You're going to get cash. Then you exercise your rights. You could buy the stock at $1.50, and so it's a way to kind of arb that difference. Now, the reason that there's that spread and it doesn't grind to the exercise price right away is because things can change. Backstop, things could happen to backstop party rights. You have to go through amended filing.
You have to file a registration statement. It needs to be approved, and so that may not happen.
Yeah. Right, there are risks to that. There are delays to when the rights offering could actually happen. I've seen it a couple of times where it gets delayed, and so you're not going to see this immediate. Sometimes you might, but typically, we don't see this immediate repricing down to the exercise price because of its risk. But what I found is as you get closer to that exercise date, then you're going to be pretty close to the exercise price, assuming that everything looks kosher.
Right, and you and I joke, particularly in the large ones, that it's sort of like, the arbitrage mechanism is almost like physics in a way, right? Like, but we've seen a lot of things happen between where the announcement happens and when the offering closes. Like sometimes they'll get called off, sometimes they'll get repriced, sometimes all kinds of things like that have tended to happen. So in terms of that, so at the very least we look at it because we think it might create an interesting trade, we'll say, at sort of a mechanical thing. And once the offering is done and closed, sort of that dynamic sort of evaporates, and maybe there's an interesting trade there, right?
Right. Yeah.
And then in terms of how we think about it on a longer term basis, like maybe it's something we want to stick around and own for a while. I think then how do we think about that?
I feel like you're leading me down a path here, but I don't know your answer at this one. Go ahead.
I think it's just our regular process. So in terms of what do we think the money's for? It's like any other analysis that we do outside the mechanics.
Yeah, I thought there was some trickery in your question. It was pretty straightforward. Yeah.
No trickerations there. Just a straight dope. And so we're looking.
Yeah. I wouldn't say. Sometimes you do it as a trade. I would say more often than not, when we're doing this, we have the idea that we do want to own the company for some period of time after the exercise period. Do we still want to own it in the size that we have? I don't know. Maybe we want to pare it back a little bit if you get some repricing after the exercise price. Sure, maybe. But yeah, we're doing these with businesses that we think management is incentivized to put money in. Good things are happening.
So how do we think about there's the tradable versus the non-tradable? How do we determine whether or not we want to try to be part of the trade, if it's non-tradable, if we want to be part of the offering or not, and versus some other instance? Because I feel like we've done over the years, we've bought rights and exercised them. We bought the company and got the rights and then exercised them and been part of that ARB process. And then there's other instances where we didn't feel like we needed to buy the rights or buy the company to get the rights because it was big and we felt like it might get to the offering price. Just nature will take its course and we'll get a chance to participate potentially, without having to go through the whole rigmarole of the exercise price process and whatever else. So how do we think about that?
I would say that that's on a case by case basis. I mean, there's so many unique factors. When you look through some of the S1 filings when they're declaring all the terms of the deal, you just have to understand what you're looking at. What's the record date? Who are the backstop parties? What's the exercise price in relation to the current market price? Are they tradable? Are they non-tradable? Because there are some times where you may look at this and say, you have a high degree of confidence that there aren't going to be issues as you get to the exercise date. You have tradable rights, and maybe you sell the stock and you just accumulate the rights. If there's a wide enough gap between the current market price and the exercise price, I mean, you're going to have to pay. There's some value to the rights, and so you'll have to pay money for that. So it's just doing the math to determine, again, that spread between the exercise price and the market price and the price that the rights are trading at. Does that make sense?
I think the one other wrinkle to it is whether or not there's some securities that are being offered that we don't think are going to trade all that much that we might want to own. So the original one that Googie pointed out to us way back many years ago, that one came with a package of warrants. And when I looked at and the rights traded in the marketplace, and when I looked at that, I thought, well, there's no way somebody's going to buy these rights and exercise them and get these warrants and want to trade them. They're just going to want to own them and hold on to them. And do I want to own them too? So there's that element. There was another one where there was like a convertible pref that was involved. You got some of that as well. And because sometimes what we've seen with these is management tends to create the security that they themselves want to own, and so you may not be able to get that security without participating in the offering. So that's another interesting wrinkle along with these. But so I think at a high level for us, it's what's the money for? It's not somebody that's serially doing this because they're constantly setting money on fire, and then sort of on a longer term basis, do we like, what's going on and how do we participate? What kind of basket of stuff are we getting and all that good stuff, right?
Yeah. And so how do you find rights offerings? I know Googie, he was on a podcast, this was years ago, where he described kind of his search process, and he sets up Google alerts for just the term rights offering.
That might have even been Producer Bobby's podcast. Producer Bobby, was that your podcast?
That was Producer Bob. Oh man, what a great podcast!
Listeners can't see hand gestures, Producer Bobby.
Wow, he gave us the thumbs. Well, he gave me the middle finger, and he gave Gary the thumbs up.
He gave me the old one finger salute.
Yeah, for not knowing
thumbs up.
It was his podcast. Well, that was a great episode.
Yeah, so he's got Google alerts set up, and we do keyword alerts in SEC filings, and that's typically the way we come across them. We've got some of them for that. We've got other ones that we use as well. Anytime, a certain word or phrase appears in a filing, maybe I at least want to take a look at the filing to see why it's there. And so that's how we tend to find some of these things. And, over the years, I mean, I don't know, maybe there's an idea or two a year that comes up this way, right? I mean, how many of these would you say that we get involved in a year? Does one or two feel about right?
I think one to two a year sounds about right.
Yeah.
I mean, they do them all the time, but like you say, some companies just do them because they're serial capital raisers. And
I will tell you the serial capital raisers are a red flag to me, but also sometimes we've seen management really try to bear hug a company, and that's also another one of those where we got to look at the people involved and whether or not we like them or whatever, and whether we think that as outside minority shareholders alongside them, we're going to be treated with respect and treated well, because not everybody treats outside minority shareholders that way. In this most recent one that we were looking at, I don't know that we'll do anything with it. I guess we'll take a look and see how it trades. And it didn't seem, what was it? It was like a $10 million offering and it was a 30 or $40 million company. So that's large. I don't know if it's large enough. And so, I guess we'll have to see what happens with that. But that was, so just as context, like, what do you consider large? Do you consider 25% of the market cap to be large? Do you consider it? I kind of think half.
Yeah, I think that's probably what I would consider large.
Yeah. enough where you're going to have people actually trying to finance it in Arbit, right? Because it was not that big. Like with the one that we did on Full House, that was not large in relation to Full House, right? It was only $5 or $6 million, I think, right? And
I don't even think that one ever traded down to the exercise price, and that's again because it just wasn't as big.
But we also had that expectation because it wasn't going to be as big, and people kind of liked and trusted Dan, and we're going to put money, or they wanted to invest alongside of him.
Right.
So we also actually in that one we didn't expect it to go all the way to the offering price. So,
yep.
No. So we have a few live case studies that we've done on these things, and we'll probably talk more about those in future episodes. But I felt like, given that we were looking at one, sort of at a high level today, sort of walking through what we, how we look at these things and sort of what we're looking for was probably some time well spent. It helps me flush out my thought process anyway.
Yeah. And like you said earlier, I mean, these are all unique in their own way. So we'll do individual case studies on each. We talked about Full House. We talked about another one when Chris Summers was on. When he was talking about his experience at Greenlight, he alluded to a rights offering that was done that you and I could talk about a little bit more in depth.
That was the old biofuel, which then became Greenbrick, right?
Greenbrick Partners. Yep. That was an interesting story. That was probably
just for housekeeping. We don't own Full House. We don't own Greenbrick. We don't own it. We don't. I don't own any of that. Do you?
Nope.
Okay.
No, I don't. You can speak for both of us with that one.
I didn't know if you had any, anything. I mean, I pay attention, but it's, there's a small residual stake or something. It's lost on me. So.
Yeah. Well, good recap on rights offerings. It was good to just chat about and flesh out our thought process. Anything else?
No, I think we've got to, we talked to somebody yesterday who's going to be a good guest to have maybe on for a couple of different ones. And so we're hoping to have some more stories with folks who can share sort of things they've learned along the way and maybe teach us some things about sort of certain market structures and some other stuff like that I think are kind of interesting and maybe underappreciated by equity investors. So hopefully we'll learn something.
Yeah, no, I'm stoked to have him on and talk about his experience. I think it's a pretty unique perspective.
All right, so you want to take us home? We're having a snow day here in Jersey, so
good for you. Well, actually, yeah, I'm getting some snow here too. All right, thanks everyone for tuning in. We appreciate it. Remember, you can check us out anywhere podcasts are available. You can check us out at inthemarkettrenches.podbean.com. Check us out at snn.network, or you can check us out on the SNN YouTube channel. That's youtube.com/SNNwire. Thanks again, everyone. Gary, can't wait to see you again in person. Looking great with that beanie. Tip the beanie.
Killing it.
And we'll talk to everyone soon.
All right. Take care.
The information in this podcast is educational in general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.